Hello, hello, everyone. Welcome back to another episode of The Week in Charge. Charlie Bilello here, and back with me once again, Jamie Battmer, just in time for the spike in volatility. Jamie, how's it going? Are you staying calm?
Keeping calm and carrying on, Charlie. Trying to keep calm and carry on.
Awesome. Okay, so if you're watching this on YouTube, take a moment, hit that subscribe button, hit that like button, leave a comment. I read all the comments, try to respond to as many as possible. What's on the docket today? Jamie, there will be blood. We know that as investors.
There was a blood moon last night. Did you get up? I actually got up and saw the lunar eclipse.
I was driving home from somewhere and I said that's an awesome looking moon. I did not know it was a blood moon, but very
I'm not.
cool. Good factoid there. Is the market down and out, or is it too early to call comeback? And we'll talk about some historical comebacks that have happened after declines like this. Fear is good. I'll explain why that's the case and want to get your take on sentiment right now, Jamie. Why you diversify? It's been a little bit of time since we've been able to kind of point to something and say, this is why you diversify. But so far this year, that's exactly been the case. We have a lot of evidence of it so far this year. It's only a few months, obviously, into the year, but interesting start to the year so far. Easing inflation. We got new CPI data, and I'm going to explain why I think CPI is likely to continue to trend lower from here in the coming months, which is good news. And we'll end, as we always do, with something positive, and that would be a new all-time high in net worth. We got latest figures from the Federal Reserve. Okay, Jamie, let's start out here with the markets. Big week, and this is the quote that I often talk about as a long-term investor. There will be blood. If I had to pick one movie title to summarize your experience, there's going to be painful drawdowns. And people probably would have forgotten this, perhaps. Let's say if you started investing in the beginning of 2024 or early 2023. Really, the last 2 years have been very, very smooth, and we talked about that in the last video. Very smooth uptrend, very few corrections, and when they happened, the market would kind of rocket right back to an all-time high. So this week, though, we had the first close below the 200-day moving average for the S&P 500 since November 2023, and you can see back then it closed below it, and then it rocketed right back very quickly to new all-time highs. So in terms of corrections, Jamie, this is now the 30th pullback since the March 2009 low that's greater than 5%. I've chronicled here all the different reasons attributed to the different corrections. You can see various magnitude. We're at a little over 10% here, and that's the first 10% drawdown from a high we've seen since 2022. And what's the reason people are saying? Of course, what's in the news? Tariffs, trade wars, and now we have this new one here, recession fears, which kind of creeps up. What do you think here? It always feels like the end of the world when you're in the midst of it. And obviously, in hindsight, all of these were not the end of the world. We did come back from all of them. Is there any reason why investors should feel differently about this pullback than the 29 others that we've seen since the March 2009 low?
I mean, look at all these. I mean, you forget about the vast majority of them. There's ones on. I remember even looking for at one point some very, leading top Wall Street strategists. Remember when there was a currency crisis with Cyprus? I remember someone saying, that it didn't even make this list. Where, okay, I remember this person saying you shouldn't run, but it's time to walk away from equities. That's a couple 100% ago, and so no. I mean, every crisis is different. Everything that triggers it, but this too shall pass. And really, the data that investors need to try and focus on is not doing what people have done before, and that you could tracing the flows during any of these, seeing that people are making the exact wrong investment decision at the exact wrong time. What you saw like November 2023. There was that volatility. That's when people were moving the cash, or October the year before when we bottomed, moving the cash. March 23rd of 2020, the exact bottom. More people selling more stock on the worst possible day ever than they'd ever sold before. And so as long as you do keep calm, carry on, you should actually embrace the volatility, take advantage of it, because hopefully, there's probably going to be three or four more of these in the next year, and most of them will probably completely forget about.
That's a good point in terms of the frequency of these types of declines. If you go back the last 100 years, you tend to see about 3 to 4 of these 5% or more corrections on average every year. Of course, you'll have some years where you don't have any, but more often than not, you're going to see a few of them. And then the funny thing, Jamie, is you often forget about the exact reason. I asked you, has this ever happened before with the tariffs and trade wars? A lot of people probably have forgotten about 2018 and 2019, but there was three here. You can see we even had a quick bear market back in December of 2018 on that same type of tariff trade war fear. And then in 2019, which was a very strong year for the equity markets, we had two more smaller pullbacks also attributed to that. So it isn't the first time. If you look at where the S&P 500 was back then, you're looking at it more than doubled, right, from that area, which is kind of interesting to note.
Yeah, it's what's interesting, is the only thing worse than pretending like you can foretell the future is when looking in hindsight, talking about how, oh, this was so obvious that it was going to happen, and that no, it's easy after the fact to say, okay, yes, this is the clear thing, but no, it's always a series of things. There's not some ordained path moving forward, and so it's just as foolish, people saying, well, oh, here's what the markets are going to do over the next 3 months, 6 months, 12 months. The only fair answer is they have no idea in the short run. But it's that same kind of false prophecy that goes in reverse order where it becomes very easy to say these things happened and they say it was obvious and they saw it coming. But typically, if they actually see the content these prognosticators are putting out, the data rarely syncs up with what they're actually saying.
Yeah, so none of this should be surprising, I think, as an investor, right? That's the price of admission. This is the chart I often come back to in terms of you're going to have these painful days. There's going to be many of them. The average year has 29 declines on a daily basis above 1%. We're tracking ahead of that this year, so we are seeing a little bit above average volatility, but last year volatility is well below average. So you're going to have some years where you see a lot of these. Some of the years you see few of them, but the one constant is they're coming, and there's going to be many more of them that come this year in terms of big market declines. And the fascinating thing, Jamie, is that if you look at each and every year going back to 1928, you're going to see a drawdown. Like there's no such thing as no drawdown. The question is, how big is it going to be? And the one we have today, if you put it in context, 10% off of the high, that happens pretty much every other year on average. So nothing really particularly unusual about it. And if you go back to 1928 and you say, well, what was the median drawdown? 13%. And that did not prevent huge returns for the equity market. It's actually the reason why you're getting that 10% long-term return over time.
Yeah, I mean, even the shorter term, say just back to the dawn of the new millennium, it's been even more so about 15% you know downturn at some point during the year, and we've had great markets, but again, a lot of volatility in the process, and so you'll take 2020 like Charlie has so well graphed here. If you just went to sleep at the beginning of the year, you avoided COVID, and you woke up on New Year's Eve, and oh, market's up 18%. It must have been a pretty calm, you know, uh, upward trend market. Where no, there was this. We were all locked in a Hunger Games type battle with our neighbors to find our last roll of toilet paper instead in between. But we just find a way. Markets always have, and it just someone just has to stay the prudent course. The difficult thing is with something like this, in a lot of those prior periods, though, there's a political dynamic to it. So someone, 50% of the people that say didn't vote this way approximately say, oh, I knew this was going to happen, and it's that additional political charge as well that unfortunately oftentimes drives people to make the exact wrong decision at the exact wrong time. You're a diehard Republican, Obama gets elected, you cash out, terrible call. Same thing if you're a diehard liberal, first time Trump got elected. And so it's just these politically infused volatility points have that additional uh, emotional dynamic to it that you just further reinforces the need to tune out the noise, tune out your own potential political
Do you think
emotions.
that's why that this feels somewhat worse, or it seems worse for a lot of people because of that additional fear over, depending on how you view tariffs. Obviously, there's many Republicans who are against tariffs too, but just that additional attachment to it versus just,
You know,
all those other reasons that we talked about earlier.
well, I think it adds because you could say, let's say you didn't vote for this particular outcome. There's a chance you might say, say I knew this was going to happen, right?
Hmm.
With that, and that it's driven forward. And yes, it's there's a lot of volatility out there, but again, the historical empirical data and academic research that drives all of our investment decision making. I mean, it's yes, you think it's wild now. It's the person on the $20 bill bludgeoned someone to death. The person on, the $10 bill was shot and killed by the vice president of the United States. The guy on the $5 bill was assassinated right after millions of Americans had slaughtered each other and in a civil war. So it always feels different, but we've always had these extraordinary political theatrics that we've the markets find a way forward.
So speaking of the historical empirical data, this is a table I often come back to, and this is why, right? This is what we're living through now is why your expectation, it's the main reason why you should expect stocks to deliver a higher return than bonds or cash over time, is this higher volatility, higher drawdowns on average, and there's no way around that. And if there was, let's say stocks all of a sudden were no longer volatile, all they did was go up. Well, there would be no excess return, right? There would immediately their prices would skyrocket, right? And because okay, there's no more risk, and then the future returns would dwindle down to something looking more like a bond or cash. So that is the main reason, right? Over time, and you're paid for taking that risk of times like this, the risk of a recession, perhaps the risk of earnings going down. It's not a straight line. And if you're a long-term investor, you should embrace periods like this because you're actually having the opportunity finally to buy in at a lower price. It's been a long time since we've seen that. So if you're thinking about your own portfolio and what to do this year, not just this year, but you should be thinking about the next 10 years plus. If you're an equity investor, reach out to us today at creativeplanning.com/Charlie. Set up a call, set up a meeting, and get a free wealth path analysis at Creative Planning. We're in all 50 states and we're international as well, so we likely have a location right near you. Over 350 billion in assets under management and advisement, and we're here to help. So reach out today. I'll have a link in the show notes, creativeplanning.com/Charlie. Okay, here's the question though, Jamie, that I'm getting. Is 2025 done? Is a bad start to a year necessarily indicative that the entire year is going to be shot? And the answer is, of course, no. And what I'm showing you here are the worst starts to a year through 48 trading days. We're 18th on the list, so definitely not the worst. But as you can see here, if you look at the remaining period of the year following these worst starts, yeah, sometimes the market continued to go down, but many times we had unbelievable comebacks. You mentioned 2020. That would be the most recent example, but 37% advance from where we were today. Ended the year, this is a price return, 16%. If you add in dividends, over 18%. So certainly not the case that the market is done here. It could go down further, but we could also see a sharp rally in the other direction.
Yeah, I mean, I know we do it we always like to be able to measure things easily and, the tax calendar, but kind of the arbitrariness of just, these 1 year increments. And it's 2008 happened and then 2009, completely different market. It all blends together. It just shows that you never know what's going to happen next. But what you absolutely know is over the long run, the market's going to recover and you're going to be rewarded for it. It might not happen through just the remainder of a calendar year, but it will happen. When markets are down, you know, even markets that are down big, when markets are up big, when markets are up more than 10% in any given year, more than half of those markets have seen a 10% or plus drawdown at some point in there. So it just occurs, and as Charlie mentioned, it's that the siren song of moving the cash, when the going gets tough, and the comfort that it's really just it's nothing more than like a gateway drug to mediocre returns over the long run. And so while it might feel good instantaneously, it's doing nothing but injecting a further likelihood of a portfolio not achieving its objective. And you have to deal with these downturns. So no, 2025 is not out by any means, but in the short run, we have no idea if it's going to recover before the end of the year or not.
Yeah, and I would say if you're an investor and you're feeling some fear here, I'd say that's perfectly normal. But you should not be losing sleep at night over this type of pullback. And if you are, you should reevaluate the risk that you're taking in your portfolio because a 10% drawdown like we're seeing, we're going to see that every other year. So you can see many more of those in your lifetime. And if you're losing sleep over something like that, probably a good time to reassess at this point. A better time, of course, would be before the drawdown. We were talking last year a few times about is now a good time to rebalance. Stocks have run up so much, bonds not haven't done so well, and you didn't know what we said at the time. Yeah, stocks could keep running, bonds could keep going down, but if there ever was a time to readjust your risk, it would have been during last year. And just in terms of timing these types of things, Jamie, I think it's often forgotten that these big down moves that we've been experiencing the past few weeks, well, what we've seen historically is it's not one-sided. Volatility is often a mirror image, and the worst days are often followed by the best days, and that's just the way markets work. So I would not be surprised to see in the next few weeks, regardless of how big this drawdown is going, I would not be surprised to see some big up days. And at some point when this is recovered, you're going to see very quickly if the market starts to say, oh, we're not going into a recession over this, where earnings are actually okay, you could see very quickly the market recover. That's been the case historically.
Like you and Peter said on your great recent podcast, it's just the price of admissions. And if you're trying to jump in and out, you're probably getting dinged by the bad days, and then you've jumped out and you've missed out on the great days that are just they're bunched together. And so, take advantage of it instead of fearing it. As I said, the volatility, it shakes out people that think things can just go straight to the moon, or the irrational exuberance. But prudent investors that are well diversified, if you're taking advantage of this, the opportunity to create additional tax alpha, rebalancing, maintaining that exposure, taking advantage of the long-term gift that is volatility can be very, very additive to a portfolio, but you just can't jump in and out because you're gonna miss these gigantic up days because you can see they're always right around the really steep red needles as well.
Yeah, and no one foresees it. You don't really anticipate the good headlines that are coming. You just think that there's going to be more and more bad ones. But at a certain point, no one knows that point. You've
Yeah,
used up all the bad news, and there's
yeah.
nothing but an upside surprise. I don't know if we're at that point just yet, but let's talk about sentiment. Let's talk about what you're hearing in terms of clients, in terms of other people. Like you're starting to see a little fear for the first time in a while, Jamie. And I'm just showing you the VIX this week. It had its second highest close since the start of 2023. Not super extreme. We had that one day back in August last year. People have probably forgotten about it when the Nikkei crashed. We had this huge volatility spike, came right back down. But starting to get closer to kind of the top 10% of VIX levels, and I've showed the chart historically. The S&P 500 returns following these high VIX levels tend to be above average. So it's good to see that type of fear. So when you think of the movie Wall Street, it was one of my favorite movies growing up. You have that famous quote by Gecko, right? greed, for lack of a better word, is good. In markets, it's the exact opposite. It's fear that is good because fear creates opportunity, it creates cheaper prices, and greed does the opposite. It causes you to chase FOMO. And we had a lot of greed, obviously, in the past few years, and finally, we're starting to see some fear. Do you view this as a good sign? And do you think sentiment, where do you view sentiment to be today?
Well, sentiment in all decision making, investments in life, you really got to question the quality, the validity of it helping you make more informed, effective decisions. Fear and greed are just the twin evil pillars of all bad decision making in investments and in life. And yes, actually, usually the data says this is a good thing, C Spike. The markets are usually doing better moving forward when there is a little hesitation, when people aren't irrationally exuberant, that's a good thing. And so we like that. But you have to be unemotional and take it out. And Wall Street, you know, the greed is good. First off, I love what very proud of our growth and success, but it's essentially, I think it's more so that Wall Street was doing it so wrong for so long. And where we've kind of focused on really trying to add value holistically is a difference because, hey, I think the guy that they partially based Wall Street on, I think he just got out of prison not that long ago. So, what that movie came out in the 80s. And so,
Yeah, I think it
yes,
was 87, right after the crash. So they
yeah,
they
Drexel,
timed it.
yeah. But uh, but yeah, this is a good sign. But again, from an investment standpoint, fear or its evil twin, greed, um, they serve no purpose. They're terrible for making the right decision.
Absolutely. And this is always fascinates me though, Jamie. I mean, if you're going to do something as an investor, you should do the opposite of the crowd when they're at an extreme. And this is a survey that the AAII organization does every week, polling individual investors, asking, are you bullish or bearish or neutral on the stock market? And we recently just plummeted in terms of the sentiment. And this is looking at a spread between the bulls and the bears. It's a negative 40% spread. So bears outnumber bulls by 40%. You very rarely see this type of extreme negative sentiment. It's kind of hard to believe with only a 10% pullback in the market, which kind of lends credence to what you were saying in terms of this feels extra worse, perhaps because of just the news cycle and the political element to it. But it's it has sentiment hasn't been this bad since 2022. 2022, we were in a 27% bear market at that point in time. Here we are only 10% down from the high. So all else equal, I like to see things like this. I get nervous when we see the opposite, when everyone's only pointing out the good things that could happen in AI and all the expectations are very high. It seems like we're getting a reality check, and we're talking about there's going to be blood as an investor. This is one of my favorite quotes. The time to buy is when there's blood in the streets, even if the blood is your own Baron Rothschild. What do you think, Jamie? You see blood
Yeah,
on the streets yet? I'm
in my
not.
opinion, right, the greatest investor of all time. Uh, but no, again, interesting what we were talking about earlier. There's probably a little bit more sentiment with the political emotional dynamic to things. But no, again, we have not gone. First off, a well diversified, globally diversified equity portfolio isn't even down close to 10%. Yeah, right. There's elements. So you're not putting all your eggs in the S&P 500 basket,
Yep.
but we haven't gone down what you go down typically. But the sentiment and also the talking heads, both politically or from a financial standpoint, they get it wrong as much as anyone else that says they have a crystal ball. I mean, I take you know at the darkest moment of COVID, right when the markets are down 35%, one of the leading Wall Street firms, not just grab money, said we're going down another 15% from here. Well, that didn't happen. And, 100 days later, the market actually recovered 50%. So in some capacities, they only missed it by 100%. And then, The global financial crisis of '08, starting that year, the top Wall Street strategist polled by Barron said the S&P 500 was going to make 11% on average. Well, it only ended up being down 39% instead. So the top Wall Street strategist just missed it by an even 50%. So yes, again, they didn't know. No one knows. If it's their blood, if it's your blood, the blood is going to happen. And it's the time to actually lean in instead of acting emotionally because of it.
Yeah, I don't view this as like a March 2009 moment or anything. You have to put it all in context. It's
Yeah.
definitely better than it was at the peak a few weeks ago, but certainly not anywhere near that type of extreme. But it's not, as we'll show here in the next segment. There are some areas that are well off their highs, and I think that's adding to the sentiment because if we look at things like the Magnificent Seven and U.S. stocks and growth stocks, they're kind of reversing what they've done in recent years in a decade plus trend. So let's talk about, Jamie, here probably the most important segment for investors to think about, which is obviously diversification. And for a long time, diversification was a four-letter word, right? People said, "Why am I diversified? It's only one area of the market that's doing well." And we said you're diversified really for only one reason, to protect yourself in the case that that one area that's doing well, U.S. large cap growth stocks, in case there's a mean reversion and they don't continue to outperform like crazy in the future. And we're seeing that so far to start the year. Again, it's only March 13th here. I'm showing you the data as of, but huge spread so far this year, Jamie. European stocks, which no one had on their list as top performers, up 11.9%. International overall, 6.5%. Bonds up a few percent, so doing their job in a tough market. Value stocks outperforming growth by about 10% this year, so down 1%. And the dollar is moving in the opposite directions, helping that international exposure, which is the opposite of what we've seen in recent years. And then you have growth stocks all the way down here at the bottom, down 10%. And what's driving this, Jamie, of course, is the reversal in these big names, the Magnificent Seven, with the exception of Meta, all these names underperforming the S&P 500 and the equal weight.
I thought you were gonna say what was driving it was your tweets when you flipped screens and I saw your X post. But yeah, going back one, can you go back one real fast?
Yeah.
What's interesting, we're not even at St. Patrick's Day yet, right? And so the idea of talking about, the year-to-date returns, that's the average person who lives to be 100, if they live that long, the average, they still lived 3 more years. They lived to be 103. So even if you're 100, this is an insanely short time period to consider. But actually, it wouldn't be that different, Charlie, if looking at this for the entire decade that essentially was 2000 to 2010, and where there was this justification for diversification, but international stocks doing well, bonds doing well. And then over that period, that entire decade period, US large cap growth stocks lost 33% of their value. And that's why you just can't have all your eggs in too few baskets, is that we can't allow a portfolio to essentially ossify for an entire decade, have a 33% drawdown. And so you never know when there's going to be that reversion. And just like you shouldn't have been chasing that the hot stock at the moment, there's always has been one, and right, unfortunately, people that were selling stuff after that huge outperformance of an entire 10-year period, they're saying, oh, you got to put all your money in international stocks. You got to put all your money in emerging market stocks, put all your money in bonds. Well, no, then what happened there? They all dramatically underperformed over the following decade. And so, yeah, 13 days in March, way too short, but this chart's actually not too dissimilar in what you would have seen over an entire decade. And at least it's reinforcing the benefits of diversification, why you don't want to over concentrate, because the hot dot is forever bouncing around, and that's what we've seen in the early innings of 2025.
Yeah, so you're saying let's at least get through the first quarter before we start saying there's a major reversal here. But the Mag 7 stuff, I think, is important. And if yeah, on that list of reasons, I think what's noticeably absent, in my view, if you had to say, Charlie, like, what do you really think is the reason for this pullback? And I would say we got ahead of ourselves in terms of valuations, and what we're seeing here is a multiple compression that is not abnormal given the multiple expansion that we saw in 2023 and 2024. So what I'm highlighting here is just the PE ratios of the Mag 7 and the S&P, and you can see, Tesla was at 198 at the start of the year. Now it's 118 as a PE ratio. Nvidia 53 down to 39. Apple was trading at close to 40 times earnings. I think you and I had talked about Buffett, and he's been selling Apple, and then I argued like it seems reasonable to assume he's selling it because he bought it at 10 times earnings and now it's at 40. Well, Apple's pulled back 20% and now it's at 33 times earnings. Okay. So across the board, you're seeing the S&P was at 28 times earnings. Now it's 26 times earnings. This is not it should be unexpected given the gains that we've seen in these names over the last decade. You're talking about Nvidia, like 30,000% gain, and we're seeing a pullback here that seems enormous, but given the context of what's happened before it, is nothing to write home about at all. In 2022, you and I have talked about this, but people forgot even that whole year where this occurred, right? Growth underperformed, the Mag 7 underperformed. They forgot it because in 2023 and 2024, it flipped back to the opposite side. But in terms of this chart here, Jamie, this I think it just hasn't happened in so long that people don't believe it's going to continue because we haven't seen the S&P or US stocks in that bottom third of countries or regions in so long. I can't even remember the last time it's happened. And to see the leaders like Poland, Austria, Greece, Spain, China, right? Think about all the negative sentiment around China entering the year up 19%. It's this to me, if this holds, this would be a pretty interesting reversal here. And if we look at the last 2 months, Jamie, we haven't seen this type of underperformance from US stocks, outperformance from international stocks on a 2 month basis. You have to go all the way back to 2008 to see such an extreme reversal. And what preceded that, Jamie, was the opposite, right? After the election, U.S. stocks outperformed, and you and I talked about, I think, a segment where I was talking about the narrative fallacy and like, well, what's going to hold here? What's going to stick? And all of those narratives that people had following the November election, oh, small caps are going to outperform banks and U.S. stocks, and what's going to underperform? Well, it's going to be international stocks, and it's going to be bonds are going to do bad because yields are going to rise. And every single one of those narratives, Jamie, at this point, has now reversed. Remarkable to see that, but not to me, not unexpected at all.
Yeah, narratives, it's a synonym for it's a story. People like telling stories, but the math is the math, and you never know what the future holds. And there's often a reversion to the mean. It might happen after 1 week. It might happen after 1 decade, but it occurs. And like I said, this recent European outperformance, it was right on the heels of another year where there's just a dramatic delta, like you said, in the reverse.
Yeah,
And so the only people that were really punished are those that just capitulated on a well-diversified strategy, or those got emotional, with excitement with Tesla and all the political headlines of that,
yeah.
in what has occurred. And so that's why you just have to park it. You have to park politics. You have to park emotions on the sidelines. And again, because oftentimes, again, it's the exact opposite of what typically occurs. It's usually, it's like gambling at a casino. Even if you're doing it optimally, you're still not gonna get it right 50+% of the time when you're guessing on something. The odds are against you because oftentimes the narrative that plays well, the narrative that's gonna get the most of people to agree with you is actually the exact opposite of what you have to do. You have to take your medicine when you're sick. You have to stay the course, do it right. And in the short run, it's a guess, but the long run, it's math. And there's no reason to assume that now is any different in regards to what's the right thing for a well-diversified portfolio for success over the long term.
Yeah, I think this coming back to the chart, it really kind of nails home the point that you don't always have time, and there's never a bell that's rung when you have this type of reversal, right? It can be dramatic. So markets aren't linear, and we're seeing that so far. When there's a shift, it could be very quick, which is why you need to be diversified in advance. You don't want to wait till after the fact. You certainly want to wait to, as you said, the lost decade for U.S. stocks. You didn't want to wait to the end of that decade to say, oh, maybe I should have some international exposure. And I think that's the case again today. But certainly, this is just a little blip on a long-term
Mm,
U.S. outperformance charts. Even with this reversal,
yeah.
it's nothing. There could certainly would be have to be a lot more to get back to any type of mean. But I want to move on, talk about inflation real quick here. We got a CPI report this week, Jamie, showed the CPI overall ticking down to 2.8% from 3% in the prior month, and core CPI still above 3%, but getting closer to that 3% threshold here, coming in at 3.1%. And my expectation, Jamie, is that this is going to start to trend lower. The big one that we keep talking about is shelter, right? Biggest component of CPI by far. It's a third of the index. And if we look at the real-time rental data, we're still seeing declines on a year-over-year basis there because vacancies are high, a lot of building in terms of multifamily apartments. So there's a huge lag between what the government is reporting on shelter and what the actual data is. I think that'll continue to come lower. That should push down core inflation. Then you have gas prices, lowest levels in a few years, $3.07 a gallon. So certainly good news there. And that will filter, I think, through to the CPI numbers and what the Cleveland Fed is projecting here. And they usually come in pretty close to what the number comes in at. They're expecting the CPI to drop down below 2.5%, and they're saying that we're going to get the first core CPI reading below 3% that we've seen in years. Do you think inflation is going to start to trend in the right direction if you add in all the stuff that I just talked about, but then you also throw in perhaps we're going to stop spending as much in terms of the federal government, and that will have a downward pressure in terms of prices? Obviously, the other argument is to say, well, this tariffs that we're implementing are going to be inflationary. But I think in the near term, I'm not sure that's going to come through in the data. I think the near term, we're going to see lower inflation.
Well, first off, I'm just amazed you gave the Fed some kudos, Charlie. I've never heard you talk kindly about the Fed before, and
Did
so
I
it was the Cleveland Fed in particular.
Oh, okay. Yeah.
Their abilities, but still, again, you hear something new every day,
Yes.
and so, but yes, it seems like the trend line's there, but worst case scenario with tariffs, all bets are off. It could change. We don't get the egg thing under control. It could change. So broadly speaking, the trend line has been positive for a while, and so you'd hope that's there. But so it seems like that. But could that be disrupted dramatically? Champagne tariffs go from 200% to 2,000%, or maybe they go to zero, right? The potential variable outcomes are very, very high.
That's going
But
to hurt
yes,
the Battmer inflation rate.
yeah, exactly. With St. Patrick's Day coming up. And so, but the idea is, yes, the trend line is positive in regards to inflation. Now, there might be some negative things that are pulling that trend line positive, but it is positive. But again, so variable on
So
a month
many,
by month
yes,
basis.
I can't think, yeah, so many moving parts in terms of
Mhm.
where inflation could go from here. And it's going to be fun to watch, interesting to watch. In terms of the Fed, it seems like the market's saying in March, nothing, they stay on hold, probably on hold still in May, although if this correction deepens, I think we could perhaps see a cut there. But in June, now the market is saying the Fed will resume their rate cutting, but a lot could happen, obviously, between now and June. Okay, Jamie, I want to go to the last segment here. We always end with something positive on the weekend charts, and this is rising net worth in the U.S. It's kind of unbelievably stunning to look at this long-term chart of U.S. household net worth, 16 trillion now is a total at the end of 2024. That was an increase, Jamie, of 13.6 trillion over the prior year. I think there was about 9% increase, and you can see, with the exception of 2022, the double-digit gains in 2019, 2020, 2021, obviously enormous increase, 2023, and again in 2024. Households, if you're an owner, you have stocks, you have real estate, you have ownership of your home. If you look at that stuff the last 5 years, a lot of these households are in pretty good shape in terms of net worth. Not something you hear a lot of people talk about, but I think it's an important point.
Yeah, it's great to see a positive trend line there, but absolutely to your point, Charlie, you're just rewarded more for being an owner versus a lender over the long run. And even people, that maybe can't afford the housing market, maybe you can afford to be an owner via your 401k, or say you say you don't work for a company as a 401k, you can open up an investment account. It as minimal as $5, $10, and you can start to be a part of the long term benefit of ownership. And so it's great to see this trending positively, um, and hopefully it continues in the right direction.
Absolutely, but not always. There's going to be declines every once in a while, and could it be this year? Perhaps, but the year is not over. We as we said, there could be a big comeback coming. Jamie, thank you for joining. Had a lot of fun as always. Pleasure to have you on the show. Everyone who is watching, take a moment once again, hit that subscribe button for all the latest content from us. Have an awesome weekend, and I'll see you next time on the Week in Charts. Thanks, Jamie.
Yeah, thanks, Charlie. Thanks, everyone.